All right, a very good day to you all. Welcome. My name is Ron Quaranta, chair of the Wall Street Blockchain Alliance, and I am very privileged to facilitate today's conversation. The IRS says you underpaid cryptocurrency taxes. Now what? Presented by our friends at Sovos and Node 40, members of the WSBA as well. It's really a privilege. And today we'll be having Wendy Walker from Sovos and Sean Ryan really walking us through the conversation. A little bit of housekeeping. This is being live streamed on YouTube. If you have questions, please feel free to submit them through the chat, and we will read them off throughout the entirety of this presentation. So I'm going to stop talking for a moment and let Wendy and Sean say hello, introduce themselves, and we can kick this off. Wendy, over to you.
Yeah, thank you. Hi, everybody. Thanks for joining. My name is Wendy Walker. I'm a solution principal at Sovos. That just means I'm a subject matter expert in tax reporting, and I work on our go-to-market team. So I work in emerging markets like crypto, and I work with the industry to sort of represent and help the IRS shape tax policy, hopefully in a way that helps the industry implement that in a way that we can all, live with. So I'm here today to talk about more kind of that tax operational side of tax, and hopefully can complement the webinar in a different way than maybe you're used to seeing. So nice to meet you. Thanks for joining.
Thanks, Wendy. And Sean, over to you.
Hi, everyone. I'm Sean Ryan. I'm the CTO of Node 40. And what we do at Node 40 is we track cost basis and essentially aggregate all of your cryptocurrency activity, trades, DeFi, et cetera, and bring it all into one location, assign cost basis, track that history and throughout its entire life cycle. And this leads to being able to make accounting decisions based on what you did and ultimately tax decisions. And I'm really happy to be here today. And thank you, Ron, for hosting us.
Absolutely. It's a privilege. Wendy, did you want to kick off with the agenda? We're going to be covering a lot today, and I want to make sure that we give everyone an opportunity to review.
Yep, absolutely. I'll jump in here. So I'm actually going to lead us today and talk about maybe why the IRS thinks that a taxpayer has misreported their crypto trading income. And of course, that'll lead into a discussion around what is a CP 2000 notice. So in those two sections, I'm going to be covering off on, again, a little bit about how the IRS works and how they're processing this information and potentially what's triggering the CP 2000 notice and then what that is. And then we'll kind of segue over and I'll pass it to Sean and he'll start talking about what you should do about it if you receive one of those CP 2000 notices. How to go through your records, pull things together, how you need to prepare, not only to respond to the notice, but for go forward as well, especially very timely, right, as we're heading into 2020 tax season here.
Great, thank you, Wendy. Next slide, I guess.
Yeah. So I will jump in. So, I wanted to start with this a little bit, the system diagram here. Why does the IRS think that a taxpayer has misreported or underreported their income? In these next few slides, I'm going to talk about how the IRS uses third-party 1099 and other information return reporting to enforce income tax compliance, how their systems and operations compare third-party information returns to annual taxpayer information returns, and then how that process, like I said earlier, could trigger, a CP 2000 notice. So background here is that information reporting, it is the backbone of the voluntary compliance system. So the tax gap reports that the IRS released in 2019 to the Treasury and to the Senate, they compared compliance according to tax income that they expected to receive versus what they actually received. And one of the key measurements that the IRS analyzed and discusses throughout that report is the compliance rate when a taxpayer receives a 1099 or a W-2 versus when they do not. And the last tax gap report to Congress in 2019 indicated an estimated $400 billion tax gap. And within those numbers, the IRS found that individual taxpayers, including sole props and single member LLCs, that they fail to report about 55% of their income when there is no 1099 reporting. In contrast, only 5% of income from easily verified sources like interest, dividends, wages, right? It's only 5% goes unreported in those cases. And when income is subject to both withholding and reporting, like W-2 income, taxpayers file their returns accurately, you guessed it, an estimated 99% of the time. So what does all that mean? It means that the IRS relies very heavily on third-party reporting, right? In fact, it's their primary enforcement tool for ensuring taxpayer compliance. And as a result, the IRS has a lot of IT systems that are geared towards matching information from the various schedules and returns that taxpayers file to various third-party 1099s, W-2s, other information returns that are being filed. And they compare those to make sure that both income and deductions are being claimed correctly. So the bottom line is, when information is reported by third parties on 1099s and W-2s, and the IRS can't reconcile that information to a taxpayer's annual return, a mismatch occurs, and a penalty notice, like the CP2000, can be triggered.
Wendy, while we're on this slide, and for everyone who's watching on YouTube live, certainly submit your questions via the chat. And I wanted to raise one question here, if we could, Wendy. You and I and Sean have been in the crypto space for a while, and remembering back to our prep session, it's interesting when we talk about third-party 1099 reporting in the crypto space. And is it worth a few seconds to talk about how that's evolved? If you and I were having that conversation 4 or 5 years ago, no one knew what we were talking about in the crypto space, but there really is structure around doing it. Challenges around how some of that data is matched up, but could you give a couple of moments on that?
Yeah, absolutely. And it'll be a little bit of a theme that we talk about as we go through the next few slides. But from an evolution standpoint, absolutely. Probably 4 or 5 years ago, 1099 reporting was pretty much non-existent in this space. It doesn't, not to say it wasn't required then, not to say it's not required now, but it certainly, was not something that people were worried about being in compliance with. And I think, particularly in the last 2 years, we've seen quite a movement in the crypto space, institutional investment, growth in terms of taxpayers and just investors who expect there to be more compliance around, where they're putting their money. And so, we've seen, for example, with the FATF travel rule this year, and just a more KYC, AML compliance focus. But, we're also starting to see it in the tax space as well. It obviously started with the Coinbase John Doe summons everyone knows about. It started with Coinbase, really led, I think, this in terms of beginning to issue a 1099K. A lot of the exchanges began to follow suit. Not everyone issued a 1099K, some issued a 1099B, and we'll talk a little about that. But it has evolved now to where we do have, a little bit of a blended, either no reporting going on, K reporting going on, or B reporting going on, all for just the trading activity. So.
Thank you, Wendy.
Yeah. All right, we can jump here to the next slide. So, kind of just piggybacking on what we were talking about, right? So in crypto trading, we usually see either the 1099K or the 1099B being issued. The K is part of Internal Revenue Code. Both of these forms are legally required under certain sections of the Internal Revenue Code. So this one, 1099K, is part of 6050W, which is for payment cards and third-party network transactions. And this law was actually enacted to get after payments that were being made by it was credit cards and debit cards and gift cards. And it was also to get after payments that were being made on electronic platforms like PayPal. For goods and services transactions. So the 1099K is issued by companies that pay at least $20,000 to a taxpayer, and only when that $20,000 is paid over at least 200 transactions. So if one payment is made for $1 million, not reportable because it's not being paid over 200 transactions, right? And if 1,000 payments are made that aggregate to $15,000, it's not reportable because it didn't hit the 20,000 transaction threshold. So that huge gap in reporting requirements, it's triggered several states to enact their own legislation to require reporting of the form at a much lower threshold, but and really with no limit. And then even some states like Florida, that is a no income tax state, require it to be reported. So it's not, an easier form than the 1099B, at least in terms of, getting it issued at the state level, but it's definitely less complex. And so bringing me to the 1099B, that forms part of 6045, which is for brokers and barter exchanges to report proceeds and cost basis details. from securities and commodities transactions. And the 1099B proceeds form, it's been around for a long time. Back in 2008, Congress enacted rules to expand the 1099B reporting to require cost basis details. So before that, banks would report gross proceed amounts on that form. And so because of that tax gap that I was talking about earlier, the tax gap report back in the 2000s showed a very high rate of individual taxpayers misreporting cost basis on their security transactions. And so this is probably one of the most complicated forms, this 1099B, to report to the IRS, given the background of the different transactional details that have to go into the numbers that go into this form. So as I said, we're currently seeing both of these forms being issued by the different exchanges and different businesses, in this space. And so if you can think back kind of to the last slide, naturally, as I discussed there, if two different forms are being issued, then they're obviously headed down two different paths within the IRS's document matching systems, right? And so we can talk a little bit about that.
And Wendy, while we're on this slide as well, and we talked a little bit about this in prep, and a lot of the conversations that we have, and you mentioned it here for 1099B, particularly under consideration by regulators, is these kind of crypto to crypto swaps, et cetera. And I'm sure you have as well, and Sean, I'm sure you have as well. I've had more than my fair share of emails from colleagues saying, oh my Lord, I bought Bitcoin in 2014 and never done anything with it. And I know we'll talk a little bit about this in the 1040 form specifically, but for holders who have not had any disposition event, I think that's important to reiterate, because I think there's that lack of understanding about what the IRS is trying to accomplish here. Can you spend?
That's a great point, actually. I mean, so this year, obviously, when you report, you're going to have to report if you're an individual taxpayer or sole prop or a single member LLC, you'll report the 1040, and on there you have the new question with the yes/no checkbox that you have to answer. The IRS says, if in 2020 you engaged in any transaction involving virtual currency, check the yes box next to the question on virtual currency on page 1 of the 1040. But if you actually look into the instructions and you look into kind of the details, the IRS says that a transaction involving virtual currency includes receipt or transfer of virtual currency for free, including like from an airdrop or a hard fork, an exchange of virtual currency for goods or services, a sale of virtual currency, an exchange of virtual currency for other property, right, including for other virtual currency, and a disposition of a financial interest in virtual currency, and then a transaction involving virtual currency that doesn't include the holding of it in a wallet or an account. So to your question, Ron, if you, for example, bought Bitcoin way back when, and it's still sitting in that Coinbase account, and you never it's just been sitting there and you didn't do anything in 2020, but you were actively holding, you don't need to check yes next to that box, right? But if you're trading and you're, buying additional crypto or selling additional crypto for other crypto, and you're selling for fiat, then that's when you want to check yes. And naturally, if you do so, the IRS is going to expect to see something within your return, like we'll talk about in the next slide, that sort of substantiates your gains and losses, right?
I just have to look for my wallet from 2013, Wendy, but
yeah.
Back to you.
All right. Sorry, I'm controlling the slides here, so to jump back there. All right, so we were talking about the matching. We talked about, on the first slide, we talked about the third-party returns, the taxpayer returns, and the IRS document matching systems. Last slide, we talked about the third-party returns, which is the 1099Ks, 1099Bs. And now on this slide, I'm talking about the taxpayer returns, right? So if you're an individual, sole prop, whatever, the 1040 return is going to be used. And for 2020 on line 7, you're going to include the full value of gain loss data that you calculate on Schedule D. And Schedule D is the calculation of your business or your individual taxpayer gain and losses. And the information on your Schedule D comes from the details calculated on your 8949. And 8949 is your detailed worksheet where you report your sales and exchanges of capital assets, right? And you aggregate that information from your different 1099B forms onto your form 8949. So let me recap that for a second, okay? Your 1099B information goes onto this 8949 form, And the 8949 information, right, goes on to your Schedule D, right? And then that goes on to your 1040. So, you know, and that should line up, right? So what happens if you receive a 1099K, right? So right now, if you receive a 1099K for crypto transactions and not a B, you still need to include that information in your Form 8949 calculation, because that is what legally constitutes your gains and losses for the tax year. That's the worksheet you need to use to calculate that. So yes, you will have a 1099K, but you will put that information on the 8949 and the Schedule D and the 1040. And after saying all that, it may not match up to the IRS records, right? And you might get a CP 2000 notice.
And Wendy, just to interject there, and obviously for everyone who's watching on YouTube Live, please certainly continue to submit your questions. One question I want to ask on this, and it's a bit of a digression from what we chatted about in prep. Colleagues are reaching out to us, and I'm not an accountant by training, Wendy, as you know, and asking about the challenges of cost basis from these firms that are submitting the different forms, for example. Can you just address that very briefly? Have you had those questions raised to you as well? And what does that look like in the crypto space?
Yeah, so from my perspective, my clients are the payers. My clients are the ones issuing the 1099s, and they're in a conundrum as well, right? Because the taxpayers are coming to them and saying, you know, why are you issuing? I need more information. I need this. So yeah, I mean, definitely some of them are using third-party solutions to provide maybe statements of information that taxpayers can use. But you know, generally, a lot of them right now actually are really thinking long and hard about 2021 reporting and how they can get prepared for what's probably going to be, 1099-B reporting, and particularly long term. How do you prepare for cost basis in this space in blockchain? Without regs, that's a little hard to do right now. But at least, I mean, some of as business people, at least from a business perspective, you need to start thinking about your systems and where you're going to pull data from and the business projects involved with that. So certainly some of the bigger exchanges are having those conversations with us now and really looking at that framework. So yeah.
Great. Thank you, Wendy.
Yeah. So, the point I wanted to make on this form is, like I said, as a sole prop I said, what happens if you get the K? And the point I want to make on this form is that if you're a sole prop or a disregarded entity, you still file a 1040, as you know. But since the 1099K form is for business related income, the IRS is expecting a Schedule C, right? Because that's a Schedule C and a Schedule 1 is what reports business income for sole props and for disregarded entities. And so your 1099K information should reconcile to that schedule, which would reconcile to Schedule 1 and back to the 1040. So again, when you don't include 1099K information on a Schedule C or a Schedule 1, and those forms don't align, that can also trigger a CP 2000 notice. So you kind of have a few scenarios. It's when you're receive a 1099K and you don't include a Schedule C, or when you receive a 1099K and you can't align that to your 8949 or your Schedule C, or you don't file any of this information and 1099s are filed. So those are kind of the three scenarios where the systems are going to be looking to match information, and it's going to mismatch and potentially trigger a notice. Okay, so let's jump to the next slide here, and let's talk about, well, who gets the notice? What is the notice, right? So the notice is, as we say, it's again a mismatch notice, and the IRS is telling the taxpayer that income reported by third parties on these 1099s or W-2s doesn't match their tax return. This isn't a bill. They aren't trying to audit you. They're trying to notify you of the mismatch. They recalculate your taxes due based on the information that they can verify. And that's what results in the proposed amount due that you see on this notice. And notice that this snapshot is from a real client notice that's received for tax year 2017. They didn't receive it until January 30, or notice date was January 30 of 2018. So why is the IRS just now sending the notice, right, from 3 years ago? And I mean, I can only speculate, but I can tell you that generally IRS began receiving 1099K forms from crypto payers for, the 2017 season. So they received that info early 2018, and then, returns are processed. And by the end of 2018, it makes sense that they would send out mismatch notices, and then it goes from there. I mean, each year forward. So yes, if it stands to reason that if you received one for tax year 2017 and you have also filed returns for 2018 and 2019 that have crypto, similar crypto related income, then yes, potentially you might receive one of these lovely notices for both 2018 and 2019 as well.
And Wendy, that kind of puts to bed the myth that some in the crypto space have, or holders of crypto, that, well, if they haven't sent me one, they don't know, they're not going to catch up. Arguably they will catch up.
Oh, they will. The IRS has a 3-year look back period. So let's first, understand that, right? So there's a 3-year look back period. They can open up a statute to be a never ending look back period if they can prove that you've been intentionally disregarding the tax law. So there's definite, teeth in there. But to your point, systemically, it's about a 3-year time frame that they look back. One thing to remember, though, too, is remember that IRS had to hire contractors last year to bring in to help them sift through information. So I do think, in general, return processing for crypto payers is probably, and this look back period is probably a little longer, and they're still sifting through all of that information. So, yeah.
Thank you.
All right. So, Sean, I think I'm going to turn it over to you, right, in this next section. And I think we're going to talk about kind of move more into the path forward.
Right. Yeah. Thank you for laying out that horrible nightmare of a situation we have. So why is this really not a problem until now? And it got me thinking. Part of this webinar is doing a little bit of research and trying to figure out really how we got here. And let's take a look at traditional investment management firms like Fidelity and E-Trade, et cetera. All of the activity that you're working on within those ecosystems happens on that platform. So if I have a Fidelity account and I have my retirement account there, and I have my day trading there, some long-term investments there, everything's there. And I can move it to another platform, but there's a process involved, and we'll talk about that in just a moment. But what's nice about this is because every bit of my activity is happening within those platforms, they know everything. They know the cost basis. They know my trades. Also, they know the treatment of those activities. So if I'm trading, they know the accounting treatment of those trades. They know what my cost basis was. They know what my gains were. If I get a dividend from a stock, there's a legal definition of what a dividend is. The platform knows that I received dividends, and it can then generate those tax forms. So it's doing all of those things for you. We just think in terms of, at the end of the year, we just click download on a tax form and I get my tax form. But there's a lot that goes into that. You being the person who's trading, creating that activity trail, then the platform is calculating what your gains, losses, dividend income, et cetera, would be. And then they create those forms. All of that is handled right there. It's trusted by you, the user, and it is also trusted by the IRS because it is correct. I mean, there may be, if it's incorrect, it's a bug. It's not because they misinterpreted something. So the 1099 reporting that we're getting from these organizations is complete. And that I'm including here Robinhood and Webull, and we know that they do offer crypto trading within their platform, but they do not allow deposits or withdrawals. We'll talk about that just a little bit and a little bit longer, but those ecosystems are still isolated and complete. And we contrast that with the new wave. So if we go to the next slide, today's finance, we have organizations that work entirely within the crypto space, and they are kind of drifting into the traditional space as well. But the real problem we see with 1099 reporting in the crypto space originates from how people transact in the crypto world. Unlike a traditional investment where I will sign up on TD Ameritrade or Charles Schwab, I create an account, deposit my US dollars, and I trade. Unlike the way it's been done traditionally in securities, the access to the cryptocurrencies is so easy. I can open an account on any one of these exchanges. There is a KYC AML process you go through, but then I can deposit crypto into those platforms. I can withdraw crypto from those platforms, and I can, and often do, will move from one exchange to another exchange. And why would I want to do that? Simple. Not every exchange allows every currency. And so, and also there may be better rates at other exchanges. So it's very, very common to drift from source to source to source to source. And you'll notice on this slide, I also have included the Ledger wallet and Trezor and Mycelium. These are wallets. So you can self-host your own crypto. You don't really self-host your own stocks. Now, you can. People generally don't do that though. And if you do that, it's not easy to try to sell that. I know I actually have one and it's annoying. So with the crypto world, it's very easy to get in and out and transfer around. And by doing that though, you are creating a situation that leads to that nightmare scenario Wendy so nicely laid out. So it's an incomplete ecosystem and it's partially regulated. What I mean partially regulated is it's not entirely clear what these exchanges should be reporting as far as 1099 goes. The IRS has not said you have to do this. And so it leads to some exchanges reporting 1099Ks, 1099Bs, and now this year we're going to be seeing 1099 MISCs. And so that's confusing. It's confusing to us as people who are partaking in this ecosystem. It's confusing to the IRS, who no IRS agent is looking at my crypto activity. What they're doing is they're receiving 1099s, their software systems are measuring it up, and they're saying, there's a discrepancy, send off a letter. That's inconvenient for everyone involved. The IRS, I can't imagine, is enjoying this any more than we are.
Sean, I'd like to, and obviously for everyone again who's watching, please keep the questions coming. A couple of questions I want to address, and one, I'd like to peel back the layers on that a little bit, Sean, for a couple of moments, because I think it's an important point. When you mentioned incomplete ecosystems and really no standard transfer mechanism, I think you and I and Wendy have been in this space for a long time. We're even talking about incomplete from the perspective of how things are referenced on different exchanges. A Bitcoin on a Coinbase for a long time had different symbology than some crypto on another exchange. So a lot of the work you've all been focusing on and the challenges of that evolving ecosystem really are reflected in some instances at a pretty granular level.
Yeah, it's funny that there's no QSIPs for crypto, and boy, it would be kind of neat if there were. But it's funny on the philosophical level, if there were QSIPs, then there would have to be some kind of central force, and that flies in the face of digital currencies in general. They are decentralized by their very inception. So yes, not only it's a nightmare, for companies like mine, where we are pulling in data from all different sources, and some sources will even use the same symbol for entirely different cryptocurrencies. It's not as easy as saying, oh, it's BTX on this exchange, it's BTC on that exchange. It is, it can be. I don't want to give examples, but there are examples where the same or different cryptocurrencies are being referenced by the same symbol. It's super annoying.
And that's evolving over time as we, I'm sorry, Wendy, go ahead.
I was going to piggyback and say, going back to what you asked me earlier, I mean, that exact thing is one of the biggest challenges the exchanges have in terms of how do I prepare for this going forward, right? How am I going to report this for these investors going forward with those kinds of challenges? And so that is why, companies like Sean's that's what people are, how do I take that data and make sense of it? And let's be honest, it's the same way in the traditional market today. I mean, we get data from a lot of sources through the broker-dealer markets, and it's going through a lot of, massaging and cleaning and before it gets, to the end taxpayer.
Yep. And that's an ongoing evolving conversation, Sean, right? Because, and I think we mentioned this, we're now looking at crypto-based derivatives, and they're the expanding universe of instruments that
That's right.
will need to be brought to awareness.
Yeah, you had mentioned earlier, you had asked a question about cost basis, and that is another example where you're still looking at incomplete data, because when somebody says what's Bitcoin trading at, it's like, that is a loaded question, right? Because I will go find the exchange that is trading at the most high, and I'll say that's what it's worth. But so there are hundreds and hundreds of exchanges. So how do you arrive at a fair market value? In the IRS, they kind of speak to this a little bit. They say, so long as you're being reasonable and so long as you're also being consistent, then you have a case to be made. But defining what reasonable and consistent is a little bit more complicated.
In a 24/7/365 marketplace.
Yeah. Super exciting.
Sean, we've got one question from the audience, and obviously keep these questions coming. It really represents to me that kind of difference between understanding cryptocurrency and blockchain. And the question from someone in the audience is, if everything is on the blockchain, why can't the exchanges accurately report what I owe to the IRS?
Yeah. Yeah.
which is an interesting. And if you wanted to dive into that, Sean, it'd be great to kind of lay out that dichotomy between the two.
Yeah, unfortunately, it's not on the blockchain, and this is a disconnect I come across pretty often. So the exchanges, especially the larger exchanges, they don't actually operate directly on top of the blockchain. They do touch the blockchain, of course, but when I create an account on an exchange, and I buy a Bitcoin, I'm not really, that's not being reflected on the blockchain. That what's really happening here is they are incrementing on their books ledger that I have a Bitcoin. I don't actually own that Bitcoin. Now I'm sure there are legal implications here, but that there's no reflection on the blockchain. So when we do ask for these exchanges to provide us data for what a user did, we are relying on what the exchange says happened, because there's no verifiable evidence that something like that happened on the blockchain, except in two cases. When I deposit into an exchange, that does happen on the blockchain. So I can see that transaction, which is nice because I can see a cost basis. I can then calculate cost basis for that. Now the exchange has no idea what that cost basis is. So this is part of the problem. Now we do, they don't, and it's not their fault. It's because they don't have the whole picture. And the other example where there is something happening on the blockchain is withdrawals. So if I have my one Bitcoin on an exchange and I want to withdraw it to my Trezor because I don't trust the exchange, or that's the way I do business, then that does also happen on the blockchain. But within those exchanges, they don't work on the blockchain. And there's a number of reasons, primarily cost, right? It's very expensive to do business on the blockchain at the volumes that these exchanges do. And that's, I hope that addresses the question.
Yeah, and Sean, functionally, that is represented in the regular equities markets as well.
Of course.
Things are held in street name by the broker on behalf of customers like you and I.
Right. Oh, I'm sorry. I missed one large part of that question. Is why can't they report that to the exchange to the IRS? Well, they do have the information that you did, and they do report that to the IRS. But because they don't have the whole picture, the information that flows to the IRS is very, very much incomplete. Now, it's accurate within the confines of that exchange, but that's not how we are obligated to pay our taxes. We are obligated to pay our taxes based on what we actually did. So if it went from one exchange to another exchange to a wallet to an exchange, etc., there's a whole life cycle. And that tracking that life cycle is the most critical thing you can do, because you're going to report what you owe. And the IRS is going to receive different information from you and the exchanges, and they're going to say, oh, CP 2000 letter, and you get it. You're fine. You're not in trouble. All you need to do is explain to the IRS, here's what I did. And you cannot do that unless you have that full life cycle. Here's when I first got it. You can see the path, and here's where I got rid of it. And that's the critical part that we don't have when you're dealing with these new exchanges and custodial services.
Thank you, Sean.
Okay, so this is okay. So yeah, we're seeing more and more crypto organizations move into a traditional space, and actually, the next slide we have a Venn diagram. But before we get there, it's interesting to see this in real time, that more and more banks are getting into crypto, and more crypto organizations, native crypto organizations, are kind of getting into that banking world. Especially with the OCC saying, hey, federally chartered banks can custody Bitcoin, stable coins, and they can run nodes. That's a big improvement. Now, I understand those memos are kind of on hold right now, but you can see the direction the government is going, and they don't really, of course they have a choice, but you know that this is eventually going to happen. You're going to see organizations cross into each other's paths. So actually, let's go to the next slide, because it really does kind of address that head on. This Venn diagram represents, on the left side, we have your native crypto spaces. They were created in the crypto world, and on the excuse me, on the right side you have your old school. I got T. Rowe Price in there. Your investment firms that have been around forever. And there's nothing wrong with these firms. They're wonderful firms. But you will eventually see these two circles fully overlap. It's inevitable. Most people in the crypto space that I talk to, they just know that all of these banks and traditional investment platforms are going to get into crypto. But don't forget the native crypto organizations. It just makes sense for them to slide a little bit over as well, right? You're going to see Kraken, you're going to see these organizations become banks, and then they're going to offer more and more traditional financial instruments. And actually, there should probably be a number of different other circles on here. The example, PayPal. Look at payment gateways like PayPal, Square, et cetera. They're getting into crypto. We know that they've made wild news, but they weren't really a traditional investment platform, and they're not a cryptocurrency exchange, but they're dabbling in there. And again, it all comes down to when you're a traditional financial organization and you want to dabble in crypto, you have compliance needs that are quite well defined. So the way you dip your toe in that water is by not letting anyone play outside your ecosystem. So, and here we have Webull, Uphold, and you'll see other ones that you can. Robinhood would be in here as well, where you have all of your trading activity in the crypto space being done only within their platform. That's going to change.
Sean, let me jump in there with a couple of questions if I could. And you had mentioned on the previous slide something that I think is worth calling out to get a little granular. You mentioned running a node, and just for the sake of the audience, what we're talking about is these quote unquote traditional financial firms or banks that are under OCC charter being able to literally participate directly in cryptocurrency-based blockchain capabilities from a monitoring, from a transactions and a reporting perspective. Did you want to add to that? I think that's important to let the audience know.
No, yeah, that's a really interesting point. When I first read that, my first thought was, why would they do that? Like what are they getting out of it? But far be it from me to ask that question, because there are very creative minds in this space. So there is going to be an amazing reason why that's going to happen. Yeah, it's funny. My company, Node 40, Perry and I co-founded it in 2015 originally. We weren't doing cost basis accounting. What we were doing was we were running these blockchain nodes. So when I say running a node, to me, it's just like second nature. So I apologize if I kind of glossed over that. But these blockchains don't exist except for people in organizations running these servers that are the distributed ledger. Like Bitcoin would only, you can't kill Bitcoin, they say. Well, yeah, if everybody running a Bitcoin node just shut off their node, then yes, you can kill Bitcoin. Won't happen. Don't worry. I'm not saying that this is going to happen. Don't email me angry emails, but it's these running of these nodes kind of increases the security of the network. And I don't want to get too far into that nerd.
Yeah, you can go down that rabbit hole pretty deeply. And one thing I think is worth calling out here as well is the relatively recent news on BNY Mellon allowing clients to custody digital assets. BNY Mellon is not a crypto native, buck the trend of regulation kind of organization. And I suspect it speaks volumes to the growth of crypto in the traditional retail and institutional investing space.
Yeah, I think with Elon Musk, Tesla getting into Bitcoin, it is telling all of the corporations out there, all the CFOs out there, say it's okay to put Bitcoin on your balance sheet, or at least, hey, I did it. I'm sure I did my research type thing, because he's a fair and reasonable man. So Bank of New York Mellon, that would be kind of like the same on the traditional bank side, right? So BNY Mellon did it. Then you're just going to have this flood of, the idea here is that you're going to have a flood of banks saying, oh, we want in too. I mean, if it's good enough for them, it's definitely good enough for us. And I love it. I mean, I keep telling my friends and family, like, this is the year, like 2021. It's like the dam is breaking, and we're experiencing, it hasn't just completely demolished yet, but we're seeing it crack. I'm super excited about 2021.
And so for me, just to add the tax geek perspective here, at least to that comment, is like, I think about the BNY Mellon and I think, okay, so, I'm invested in something and I received 1099-B pretty statements with my gains and loss calculations for my traditional investments, right? Like, so I would think as an investor, you'd expect to receive that same treatment for your crypto assets, right? So again, I think as somebody was probably a little annoyed earlier, like, why can't they just report it correctly? And I completely get that. And so, you know, I think that's the whole point, right? Is I think hopefully as this continues to blend, I think not only is that pushing the IRS to give more clear guidance to these exchanges so they know what to report, but I think it's also just going to be expected because institutions like Bank of New York and Fidelity are not going to, you know, jeopardize that traditional business, right? They want to give that the same experience.
Exactly.
Certainly. Oh, so transferring assets. I mentioned this earlier that if you have your entire portfolio, your traditional old world investments, which will stick around forever, of course, but if you have them all at one of these traditional investment management firms and you do want to move them to another investment management firms, so you can do that easily in crypto. It's not that you can't do it in the traditional world. It's generally that you usually don't, but there's mechanisms in place for you to do just that. And generally, they use transfer agents. 8cats is probably the most popular transfer agent. Virtually all of them use it now. In order to do this, though, you have to initiate a request. So that's a complicated process. If I want to move my assets from, here's the example, Fidelity to TD Ameritrade, these are the steps that you need to go through. You have to provide a whole bunch of information. And then the part that I find interesting here is it takes 5 to 8 days. Now, can you imagine Bitcoin right now today shoots up to $70,000 because some whale got in and now you want to cash out. So to transfer from your wallet into an exchange, you have to wait 8 days for that to happen. I can't imagine that. So go ahead, Ron. It looks like
no. It just brings to mind, Sean, all the conversations with some of the original crypto enthusiasts who looked at removing friction from the system. How do you tell them, hey, your Bitcoin is going to take 8 days to quote unquote settle? It would be a difficult conversation.
Yeah, I was trying to get my father into some crypto last month when there was all times high. It's always funny. People like to buy in when it's high, but when it's high and they're not in, it's always too high.
Exactly.
But it took a long time. It took more than a week for this process to kind of complete, but that was a one-time deal. All right, so back to the traditional world. The reason you have to go through all these steps is because there has to be it's all about compliance. There has to be a way for you to get all your stuff from one place to another place. Cost basis is going to be retained. It's essentially tax-free. And there are cases where it's not tax-free. There's certain accounts that can't be transferred without selling and then rebuying. But by and large, this can happen. But the IRS has to be aware that this movement occurred and that there were no taxable events. The same is not true for the cryptocurrency world. If I'm on one exchange and I want to move all or some of my assets to another exchange, I just do it. All I need to do is initiate a withdrawal. I give it the address that I want to send this currency to, and I hit go. Now, provided I'm within certain regulatory okays, like certain exchanges will only allow you to withdraw a certain quantity per 24 hours or a dollar amount within some time period. There are compliance efforts on that. So I don't want to say that cryptocurrency worlds, all the problems are solved. There's no regulations. That's not true. There are regulations and they're reasonable regulations. But once the transfer has been initiated, it's very, very quick. It's usually the time it takes to confirm a block. And I know that there's people on this that are probably saying, well, no, it's going to be 10 confirmations or 50 confirmations. Yes, there are those, but the assets being moved have been moved. And cost basis is assigned at the time the transaction was written.
And Sean,
now, go ahead, Ron.
I'm sorry. I was just going to say, and one of the questions we should probably address for the audience, you mentioned travel rule here. You've talked about regulations, and I think it's worthwhile expressing to the audience how some of these regulations are evolving. And the three of us talked about FinCEN and the movement of crypto funds at 3,000 or 10,000. So for the audience's sake, that's something really to try to keep abreast of. Did you want to comment on that just a little bit?
So one, most importantly, and what I have on the slide here is the travel rule, the FATF travel rule, which is exchanges are still struggling with. But the idea here is that in order to move value from one exchange to another exchange, there's some information that has to be verified in order to do that. It has nothing to do with cost basis. It is not going to solve any tax problem. It may delay your transfer in certain situations, but it is not at all addressing tax. It is addressing strictly anti-money laundering, which, the risk of getting people mad at me. I mean, it's not totally unreasonable, right? I mean, if we want true adoption, we have to, there's a give and take. I'll give this a little bit. Now, as far as the FinCEN rule with the hosted versus unhosted wallet. So if I have my Bitcoin on an exchange and I want to withdraw it, that exchange, the rule proposal is that if it's, I think if it's over $10,000, they have to report that information to the IRS. If it's over $3,000, they have to retain the records, and then they will eventually report it if there's a subpoena involved. So when I say information, what am I referring to? Well, that's kind of like the question. What information? Name and address of the custodian. Well, the custodian is my Trezor. It's not. My Trezor doesn't have a name and address. I mean, it does have a name, but it doesn't have an address. And more than that, there's different ways. What about DeFi platforms? So if I'm on a DeFi platform and I deposit and I send from that DeFi platform into one of these exchanges, how on earth is that going to work? So there are technological questions here as well. And again, none of this goes to addressing cost basis or tax, right, even though we now know, the IRS now knows that the cost basis and disparate sources are the root of the confusion. I think in the near future or midterm future, we are going to see efforts by the IRS and regulatory agencies try to solve that problem. Mm-hmm. And they're probably going to be using a really heavy hammer at first, which kind of like the FinCEN rule you can look at as a heavy hammer. 15 days to comment over Christmas. I mean, come on. So let's be reasonable here. I think the crypto community wants to be reasonable, but you have to, all right, that's getting too political.
And so to level set for the audience, Sean, Wendy, I'm sorry, go ahead. And then
I was just going to piggyback and say that that is actually something the IRS is looking at, right? And I know that just from industry participation with IRS throughout last year. They hosted a day with crypto exchanges where they really took the time to understand how the transactions work and understand what the difficulty is with reporting cost basis, getting cost basis from one another. And it was this kind of like aha moment, like, oh, there's no transfer agent process, like there is. Yeah. So that was just one of the obviously glaring things that we had to sort of highlight to them. And that's why cost basis cannot, be reported right now. And so, could you get to it? Maybe. I mean, but, again, you heard some of the things Sean talked about. So, but yeah, they're definitely looking at it for sure.
Yeah. And I do want to highlight that FinCEN thing we were talking about collectively, the three of us, is not a rule right now. It's being contemplated by regulators. And I think with the change of administration, a lot of these rules are going through a much more extended review period. And for the sake of the audience, just a level set, when we say DeFi, we mean decentralized finance, which is more broadly peer-to-peer transactions in different types of crypto or crypto-based instruments.
Right. Sorry about that. So DeFi, I'm going to talk about this in a couple of slides, but there's a difference between identifying what it is you did and then applying accounting rules to that. And DeFi, being decentralized finance, it introduces a new set of challenges for you, the taxpayer, and absolutely the IRS, because although certain centralized exchanges and decentralized exchanges, they will use terms like interest or dividends. You could be careful because the tax treatment of that behavior, these DeFi services, yield farming, all the new terms that you're hearing in DeFi that produce more value for you now, new tokens or more of an existing token. These are interest earning initiatives. But when it comes to reporting that to the IRS, those are not being reported on a 1099 div. All right. They're not dividends. They're not interest. They are being reported as miscellaneous income. And there's a reason for that. There are very strict understood legal definitions of what these behaviors are. So in the DeFi world, if you're playing in that world, just be careful of what you're doing. That doesn't mean don't do it. It just means understand what it is that you are how you're earning your money, so you are better prepared down the road. All right. And we're running probably close on time, so I'll kind of shut up.
Yeah, I'll jump through this one then. This is really just a recap of I think from the last slide, right, of what the exchanges are sending to each other, and what's being provided during a transfer between the exchanges. And so how does that impact the tax information reporting? And I think Sean's done a good job of talking about that. But on the right side, we can say that you can see that from a tax reporting perspective, you need to receive a 1099-B that includes cost basis details that you can input on your 8949, move to a Schedule D, and then calculate your gains and losses to put on the 1040. Coinbase doesn't have that cost basis data, right? When Gemini sent over the information, that wasn't included in the details. So later on, if you transfer your crypto to another platform, they can't possibly give you a 1099-B with correct cost basis, right? They can really only report what you sold it for, right? And we call that gross proceeds on the B. And so it's really the same as what you're getting on a K form today, right? So even if they reported that gross proceeds B, outside of it, probably at least you can line that up and it will match up with your Schedule D and your 8949 from an IRS perspective. At the end of the day, if it doesn't give you the cost basis information that you need, you're still going to have to recreate all of that detail on the 8949 that Sean was talking about before. So, and like he said before, not an issue at Robinhood or PayPal, right? Because those platforms don't allow you to transfer in assets from other exchanges. So you buy and sell on their platform, so they have access to your cost basis details for 1099 reporting purposes.
And Wendy, just to peel that back a little bit, and obviously for those watching, please do keep questions coming. It's something that you and Sean have said repeatedly in the past, which is kind of document or narrate the story around the things that you're doing in this space. And I think, Sean, you're going to address that in a couple of slides as well. But the importance of capturing the story around what you're doing is critical. And I think I've certainly overused the phrase, it's not what you know, it's what you can prove. And
That's right.
Do yourself the favor of documenting so that you can prove.
That's right. I mean, listen, as we said before, these are details that, once you have demonstrated that you've kept track of that information and you've been responsible about it from a tax perspective and can demonstrate that to the IRS, it's not something they're likely going to challenge, if you're trying to do the right thing. But yeah, don't let it get too far before you don't have access to that information anymore, or, it's just becomes so difficult to recreate that it's a nightmare to do.
Exactly.
Yeah. Okay. So, we talk about the fact that, again, as I've emphasized throughout today, IRS will send the mismatch letters when they receive 1099 information that doesn't match information that was filed on corresponding returns. In this case, they don't have correct data for crypto transactions. And so we've seen a lot of letters and notices sent to crypto investors these past couple of years. And, like I said, it's even harder when exchanges use the incorrect form, the K, versus the B. I think I've demonstrated today just, the purely tax operational issues that the IRS has associated with issuing that form to taxpayers in terms of how they, receive and process it. But, one alternative could be, as I said before, that exchanges could all issue a B to kind of at least cut down on some of the CP 2000 notices that are going out there. But again, if it doesn't contain cost basis, you still need to track the details. Or what you could do for 2020 season that Coinbase did is don't report at all. So they have obviously interpreted that the 1099K is not the right form, guessing that's based on taxpayer issues that some clients might be experiencing. And they've obviously interpreted that they don't need to report any 1099 for their trading activity because that's what they've sent out and notified their clients of before the end of 2020 in the January season. So whether the IRS will agree, I guess, is another matter, right? But having said that, it's not just trading income anymore. You heard Sean talk about a 1099 miscellaneous before. So let's be clear. You might have if you're an accountant or you're an investor yourself, you might have a taxpayer, you might yourself be earning staking reward income as an example. Most of the industry is reporting that income as ordinary income on the 1099 miscellaneous. Some payers call that product interest on crypto assets. Again, industry is reporting that as a 1099 miscellaneous as ordinary income in box 3 for those products. So, so from that, just understand that you need to be aware of what's your cost basis income or what's your income to calculate gain and loss versus what's income that's going to be staking income that would go in another part of your tax return. Okay, let's jump forward here. So yeah, we're getting a little short, I think, on time.
We're running up against the clock. We always talk about going over, Wendy, and I think we could
I
do
know
that.
we're worried that we don't have enough time, but this is my favorite slide actually. So.
Oh, I'm so glad. I'll keep this short then, which unfortunately this is a very important slide. All is not lost. Okay, so unlike with the traditional management platform, they're doing all of this for you. They're tracking your history. They're keeping track of what trades you did. They are applying known accounting rules, and they are letting you download the forms. In the crypto activity world, you are responsible for doing this yourself. And so the foundation here, what you did. Now you're going to need to use software, of course. And I'm not, this is not a pitch here, but it's important that you're using software that can grab all of your different transaction data, no matter where it sits. That's either on blockchain or off blockchain. The off blockchain would be those like the online exchanges. On blockchain, you can look at something like a decentralized exchange or your own wallets. If you have to get a good record of what it is you did, you bought, you sold, you withdrew, you moved, there's certain things that you can do. That has to be, that's your raw data. You need that raw data because that is going to be the foundation by which you send that off to somebody who knows better to apply accounting rules. So that's either lawyers or a CPA, or maybe you just simply interpret what the IRS has already said. There are very clear positions the IRS has taken. I'll give you an example of how applying accounting rules to what you did becomes really critical. There are people out in the crypto world that believe staking rewards are not income, or they should not be taxed as income. I'm not going to take a position on this, okay? But what I can tell you is that if you take a position that is kind of in the gray area, and you see this a lot, you see individuals saying, well, I don't need to do, well, okay, then narrate that position. Draft a paragraph that explains why you think that this particular rule applies to this type of behavior. And it all boils down to being able to back up that you did that behavior. That's the what you did part. You have to get that right. And that is a rules agnostic piece. Then the accounting rules becomes the interpretation of how you're going to treat the tax behavior for those activities. And then ultimately hand this off to a CPA. They can create tax forms and file your taxes. But the two in the middle here, the accounting rules and the what you did, super critical. Write yourself a letter. This is what my interpretation is, because Wendy was clear. You're getting letters from 2018. The IRS is 3 years behind, or it would have seemed they're 3 years behind. I don't remember what I did in 2018. I did a lot of activity back then. I hope I did it right. Pretty sure I did it right. Yeah, I did it right. But I have a narrative also. And when the IRS comes knocking on my door, I'm going to hand them that narrative and say, here, there's a justification to the decisions I made. And here's all the raw data. There's piles of it. You can go dig through it. That's the critical component.
And Sean, just to dive into this a little bit, and when we see terms like staking, mining, burning, loaning, just to, for those who aren't aware in the audience, those really are iterations of the things you can do with crypto that may or may not have implications, but they also, and if you and Wendy wanted to comment on this very briefly, and I know we're running short, they also represent opportunities for the accounting profession over time to both weigh in on how they should be managed, as well as there will be clients who don't know how to deal with this. The accounting practitioner who can show them really is in a good spot.
Yeah, I mean, my role in the crypto world with my company is we focus on what you did. We have to provide some amount of accounting rules interpretation, but they're very, very minimal. And we do allow you to change that behavior. So we have default conservative, reasonable positions when we even need to take a position. But like Ron said, there's a lot of stuff you can do with crypto. The DeFi world, that deserves its own webinar. But the DeFi world allows you to do a lot of crazy stuff. And I see some insane portfolios. And I just, my eyes go numb. I'm like, I can't imagine trying to wrangle this without software.
Well, and from my perspective, I mean, I love this chart because I love this diagram because, I mean, you could say the same thing about exchanges or payers, right? Like everything that you do, the decision you make to report whatever 1099 you report or don't report, what goes into that 1099, all of that is what you did, and certainly works very closely with the interpretive piece. And as you heard us talk about throughout the day today, that's what's missing, right? The payers, the exchanges, they don't have that interpretive piece. They don't have guidance from the IRS. And frankly, I don't know that the IRS has even given all of the guidance that we need, for example, in crypto lending or,
Right.
even in crypto staking, right? So until the IRS gives that interpretive guidance, I think even as Sean's articulating, all the right things to do from an accounting and tax perspective to document your records and be prepared for tax purposes. But unfortunately, you're trading in a new market, in an emerging ecosystem. And until the tax system catches up with that, it's likely that as those new products come, differing interpretations will come, differing 1099s will come, and it could throw that off for you. So be prepared.
Yeah, and truth be told, the only reason my the accounting software part of my company even exists is so Perry and I we were doing this. This what you did, that was us building software so we can tell the IRS what we did because we were very sure we were going to be audited.
And I realize we're just about out of time, and I want to be cognizant of that. I don't think we have a lot of slides left, but Wendy, you and Sean are thought leaders in this space. So if you wanted to go through this slide quickly and then share your contact information, I think for colleagues in the audience, it'd be important for them to see. And I'm looking forward to the DeFi at some point webinar, Sean, at some point down the road.
I would love to do that.
He obviously has lots to say about it. I'm excited too.
Yeah, absolutely.
But we can skip that last slide. It was just a recap. Just be sure you have the records. It's not just about getting a number. That number has to be backed up by calculations that went into creating that, because the IRS doesn't care whether you're right or wrong. It's whether you can prove it.
Show your work.
Exactly.
Show your work.
So always a great conversation. Thank you for everyone who watched. Anyone who's got additional questions, please reach out to Sean. Please reach out to Wendy, all of our friends at Sovos and Node 40. It's been a privilege. Looking forward to doing it again. Thank you both.